Yeah, so the market hasn't really done much, barring a few scripts. There was a mid-cap rally that happened and it sort of got neutralized, and it hasn't really done much in that sense. So there are 2 points here. One is that there has been a huge inflow of FI money in the last few months, which is basically playing on election verdict, because last time when Mr. Modi won, there was almost a 21% rise, and they are sort of trying to time some of that, which may find an exodus from the market, and then things will be back to normal. So let's assume that there is a 3 to 4 to 5% correction in the market, irrespective of the election verdict. The question is going to be what is going to be the run-up before that, and if it's 2-3% before that, then you're really not talking here and there. I think things will come back to whatever the economy does and how companies perform. There's a very interesting situation that in terms of an absolute price to earning, the market looks expensive compared to its historical past, but we should also be mindful of the fact that barring a few sectors, there has been no real growth in large number of other sectors. If that growth becomes real, then the entire PE will sort of be revisited and the market will look cheap. And India has not had a growth now for some years, in large number of sectors, particularly capital goods, infrastructure. The banks have gone through, particularly public sector banks have gone through a lot of nightmares. NPAs are sort of getting resolved, etc. So if there is a real growth, I think the PE will look okay. And on the other hand, if India again sort of misses the growth, and the growth is only a delusion, then the market will end up looking much more expensive. Let's take both situations. Let's assume the NDA government comes to power. I think the first catalyst that should happen is that they will have to kickstart several sectors of the economy that have gone into a slowdown. For example, automobiles, housing, etc. There have also been several promises on cutting the tax rate for corporates, which will be a complete benefit for companies because it will enhance their bottom line straight away. Let's assume, on the other hand, there is a coalition government that comes. Now, the question is, when a coalition government comes, will it not benefit businesses? And they're supposed to give orders to people. They're supposed to scale up things. I don't think, while it will be sentimentally taken as a sort of a negative that it's a coalition, but India has seen several coalitions, and I think things will be back based upon how the companies and the economy performs again. Let us assume that there is a government, a contrary government, if I was to call it, or a coalition government that comes into power but announces investor-friendly mechanism. For example, let's assume that long-term capital gains is scrapped. Now, the market will find it extremely difficult to measure without knowing how to reward that. And that is one of the reasons why historically the markets have performed irrespective of the governments, because it is very difficult to assume that a new government will be anti-industry. And I think, therefore, there could be a knee-jerk reaction to an election result when it comes out, but that may also end up being an opportunity depending upon how severe the reaction is. So I think when a person constructs a portfolio, the portfolio should be constructed according to different baskets. For example, there is a basket that only banks upon India's population and a play on the population, which is essentially consumption, and by extension, consumption also includes certain other peripheral things like housing and finance and paints and other things. That part of your portfolio has grown historically, irrespective of which government came into power. There's at least a 5 to 6% growth that happens in those sectors, and therefore you will remain attracted to those, and they will be one part of your portfolio. So let's assume they are the consolidating part of your portfolio. The second part of your portfolio will be emerging opportunities. Some of them will be small and mid-cap companies, and some of them will be in industries that are now coming out by variants. For example, historically I've not liked corporate banks, but corporate banks are now seeing a transition because of the resolution of NPA and many other issues. Similarly, there are other companies that are now coming out of debt traps and are becoming debt free, and they will be better plays in that. And the third part of your portfolio will be more aligned to government policies, and that call you can only take, like for example, when GST was introduced, one of the bets that I took and I wrote about was a transition from the unorganized sector to the organized, and those themes you will only play based upon government policies and all that. So effectively, you will right now concentrate on the first two parts of your portfolio, that is buying IT and consumption and banks and companies in those sectors. In the second part, there will be companies which have undertaken capacity expansions, have improved their balance sheets, etc. And you will play those mid and small cap companies that have credible managements. And then the third side, right now, you will ignore everything because you're not sure about which government and which policies, and you take a call once that is resolved as a third portion. So there are these transitions that are continuously happening in the economy. For example, there are certain businesses which are extremely capital intensive that are moving to becoming more cash rich and less capital intensive businesses. Some of these can also include, for example, a hotel in infrastructure as opposed to a hardcore infrastructure company. There are examples of how value is being added in paper. I mean, in traditional sense, we would assume that paper consumption is coming down, but in reality, higher value added paper is setting in, and people are moving into tissue and they're getting into pulp, their own pulp and value added handmade craft paper, etc. So the transition is always happening, and one of the biggest examples of transition is what is happening now to the PSU banks. All of a sudden they will move from losses into profits because most of their NPA aggressive write-offs are off, and they will hopefully become more vigilant in terms of capital allocation. At a certain point of time, pharma became the bad boy of the industry, and there was therefore a huge amount of value in the sector because the prices were so depressed. These companies had already undertaken huge R&Ds, and Indian pharma has transited from purely generic into an R&D, and therefore there was huge amount of expenditure. I mean, just recently I read an article in Outlook's latest issue itself where it spoke about how Dr. Reddy's has almost 100 billion rupees write-off in respect of some of the R&D that it has done. And some of those transition models have already, so the pain, it's the lava is ready to now catapult into a butterfly, and the pain is already into the system and the price is favorable, so you will take those plunges. Whereas there may be other sectors where the going is very strong because consumption has been good and the price earning is caught on, and the market may be now getting exposed to greater competition or lesser margins, or the benefit of the capex expansion is already over. And there, if you find that the valuation is higher, then you will probably have to slow down or sort of move out of those scripts because the opportunity cost will be very high. As strange as it may seem that having been a bear on PSU banks, I actually feel that there might be a huge catalyst in some of the PSU banks. You have seen the transition of ICICI Bank and Axis Bank on the private side, and I think if things don't mess up too much, then State Bank of India and some of its subsidiary companies may actually deliver. They have a great insurance business. They have SBI mainframe. They're doing a good transition now in terms of cardless transactions for credit card, etc. And if things don't blow up too much, then maybe State Bank of India could be a dark horse for 2019. The real money will always be made in mid and small caps, and that rule I don't think is going to change. That is why the chase for small and mid caps has more risk, because the discovery process is much more difficult, but therefore it compensates you in return. And I think one of the interesting parts of the rally that have happened in the last few months is that the market has turned a disbeliever in mid and small caps because of the meltdown. Now, historically, meltdowns do not mean anything. It doesn't even mean that the bull market has been displaced. These are inevitable. Some of the mid caps and small caps went up 2x, 3x, 4x in the last few years, and they may have corrected 30, 40, 50 or even 60%. And some of them will actually find the going good. So I think the greatest returns will still come in finding a good mid cap, which is not yet transited beyond the 500 crore market cap into 1,000, 2,000, 3,000 crores, and you still make a lot of money there. The sectors that will look most susceptible in the event of a meltdown could be, for example, divestment could suffer, because divestment is a complete catalyst of government confidence, and most of the divestment is done in the hands of either LICs or foreign institutional investors and domestic institutional investors, and they may not be so inclined. Similarly, if more problems like the ILFS problem or the current problems with some of the other companies in terms of debt continue, then even some of the financial sector, some of the financial heroes may not end up being the heroes that we expect. But barring that, overall consumption and pharmaceuticals and all should continue. In fact, pharma is actually reviving completely, because most of the US FDA inspections have now become more routine, and they are becoming more of observations and not really banning of facilities. And a lot of the drug discovery that was delayed or had not been monetized in the US and other markets is now actually setting in. And also the domestic market is sort of has priced in over the price controls and other sort of regimes.